Hey guys, it's Victor with BCM and welcome to part 3 of Learn About Options. In part 1, we went over the basics of options. In part 2, we looked at some simple examples of long calls and long puts. And in this video, part 3, we're going to look at selling options. If you are brand new to option investing, then I recommend that you watch parts 1 and 2 first. I'm going to go ahead and put the links in the description. Otherwise, let's get started. In this video, we're going to look at how short call and put positions work compared with the long positions that we've already looked at in part 2. Next, we'll talk about the pros and cons of selling options and try to understand why investors would sell options to begin with. And then, of course, we'll also look at some examples of how to put option selling to use. And I'll also provide some background information about how option markets work. So just like we can buy calls or puts to take long option positions, we can also sell calls or puts to take short option positions, which are basically just the opposite of the long positions. A couple of quick notes here, just as with part 2, the examples on this page are going to reflect stock prices as of the option expiration date. On the left side of this page, we are taking a short call position. So we are selling an at-the-money call with a $100 strike price, and we're going to receive $10 in premium for that sale. If any of that doesn't make sense, please watch parts 1 and 2. Now we can see from the P&L diagram that a short call provides limited profit and unlimited loss. This is the exact opposite of a long call. And in fact, this P&L diagram, this profit and loss diagram, is basically just a long call diagram flipped upside down. Now let's take a minute here to understand why this short call has this particular P&L profile. When we sell a call, what we're doing is we're selling another party the right to buy stock from us for $100 in this case. Now, in exchange for that right, we're going to receive a $10 premium payment. So the most we can make from selling this call is going to be $10 because that's what we sold the call for. That's why there is a horizontal line at the $10 profit marker. That is the most that we can make. Now, on the other hand, potential losses for a short call are unlimited because the stock price can keep going up. Remember, the other party has the right to buy stock from us at $100. So if the stock price goes up to $150 after we sell the call, we might have to go and buy the stock for $150 and then sell it to the other party for $100. We would obviously take a loss on that, and that's shown as the downward sloping line that we see on the right side of the chart that's on the left side of the page. Notice to the right of our break even, which is 110, shown as the gray dot, we are going to lose dollar for dollar as price goes down as price goes up, excuse me. We're going to lose dollar for dollar as the price goes up, and there's obviously no limit on that upside movement. Now on the right side of this page, we have a profit and loss diagram for a short put position. Again, this is just a long put position flipped upside down. We're going to sell an at-the-money put with a $100 strike price, and we're going to receive a $10 premium. So our maximum profit is $10, again, because that's what we sold the put for. Our maximum loss in this case is $90, which is the difference between the $100 strike price and the $10 premium that we received. That's also our break-even price for the short put. That's shown as the gray dot on the chart on the right. Now, why does this P&L profile look this way? Well, because whoever we sold the put to, that party can force us to buy stock at $100, the strike price. So if that stock ends up being worthless, the stock that we have to buy at 100, if it ends up being worthless, we're going to end up losing the $100 we paid. But we get to keep the $10 premium that we received. That's why the maximum loss is $90. So that was a lot of stuff pretty quickly. We're going to do a quick summary of this on the next page. This table shows a side-by-side comparison of a short call versus a short put. One thing I want to point out here is that both of these short positions are options by themselves without any corresponding stock positions. So we're only looking at options by themselves, no stocks. This is also known as a naked option position. So when we sell naked options, there's usually going to be a margin requirement. That means that we have to maintain some amount of collateral in our investment account, the account where we're shorting these options. It's usually a percentage of the position value, but the specific amount that's going to depend on the position itself, as well as margin rules that are set by regulators, as well as the brokerage firms where our accounts are held. Now, right here, I'm just using a generic example of 30%. That's not necessarily what it's going to be. It's just a generic example. And if that was the requirement, 30%, and we sold an option with a $100 strike, then we would need to have collateral worth 30% of that value, or $30 in this case. We'd have to have $30 in our account. Now, we do receive $10 from selling the option. That means we would need an additional $20 of our own money, of our own capital, to put in the account to get to the 30. That's why the required capital is shown as $20 here on this page. Now we know that both the short call and the short put have a limited profit, a maximum profit of $10, which is what we sell the options for. The short call has unlimited loss potential because price can go up without limit. And the short put has a maximum loss of $90 because the stock price can only go down to zero. Both of these option positions will experience leveraged returns when compared to just regular stock positions. That's the same as with the long calls and puts we talked about in part 2. And this is because the options have a lower capital requirement. Now, something you may have noticed here is that the P&L profiles, they don't look that good. They don't look that good for either position. It's because the most we can make in either case here is $10. But we could lose substantially more than that in either case. So why would anyone want to sell options in the first place? One reason why someone might want to take a short option position is because short option positions can be combined with other positions to change P&L outcomes. For example, let's say that we owned stock at $100, so we're long the stock. Next, let's say we also sell a call with a $120 strike price, and in return for that, we're going to receive a $10 premium. Now, this combination of a long stock position plus a short call position is known as a covered call position. That's versus the naked calls that we've been talking about prior to this, which was just a short call option by itself. So let's think about how this covered call position would play out. So we're long the stock at $100. Let's assume that when the option expires, okay, a few weeks out, the stock price is trading at $105. Well, what's going to happen is that call that we sold, the call we sold with a $120 strike, it's going to be worthless now because nobody is going to want to buy stock at 120. No one's going to want to use the call to buy stock at 120 when the stock is only trading at 105. So what happens at expiration in this case is that we're going to make $5 from the stock price movement. It went from 100 to 105. And we're going to make $10 from the option premium because the option is now worthless. That's a total gain of $15. If we did not sell the option, we only would have made the $5 stock price gain. So in this case, we are better off having sold the option than not. Now, what happens if at expiration the stock is much higher? What if it's at 150, so above the 120 strike? Well, then in that case, we could be forced to sell our stock at the $120 strike. If the call ends up getting exercised, we're going to have to sell the stock at 120 because that's the agreed upon strike price. Now, we would still get to keep the $10 premium that we made. So our total gain would be $30, right? Stock was at 100, it went up to 150, but we had to sell at 20, giving us a $20 gain, and we also keep the $10 in premium, which gets us to $30. So we would still make a gain, but it would be less than if we just held the stock on its own, because then it would be worth $150. Now, that isn't necessarily a bad thing. And it's not necessarily a bad thing if we were already planning to sell the stock, right? If we were already thinking about or planning to sell the stock in the first place, then it's not a bad thing to have to sell it. For example, if we decided when the stock was 100 that we would be very happy with a $120 sell price, then it could make sense to sell the call, right? Because if the call ends up being exercised and our stock gets called away, that just means that we got our desired asking price for the stock. We wanted to sell at 120 and we sold at 120. In addition, we also got some premium, right? We got $10 in additional premium. So covered calls can be a good way to enhance a sale, right? We're going to sell anyway. Why not generate some premium, some extra return, some extra gain while we are waiting to sell? There are other times when people sell covered calls specifically just to generate income, because every time we sell, we're getting this premium payment, right? And they may sell this call without any intention of ever actually selling the stock. They just want to hold the stock and continually sell calls. And you can do that. We can accomplish that by selling options that are, maybe farther out of the money, or rolling options forward if they become at risk of ending up in the money. We're going to talk more about what that means later on. But for now, the second example here on this page is a cash secured put. This is combining a short put with a cash position equal to the position value. So for example, let's say we sell a put with a $100 strike price, and then we receive a $10 premium. If we hold an additional $90 of our own cash in the account, then we're going to have 100 in cash, which makes it a cash secured put position, right? There's $100 of cash in the account and then a short put with a $100 strike price. Now, if the stock price ends up anywhere above $100 at expiration, at option expiration, then what's going to happen is that put becomes worthless. The put we sold is worthless, so we just keep the $10. That is our maximum gain. If the stock ends up below the $100 at expiration, then we might be forced to buy the stock at the $100 strike price. Again, that's not going to be an issue because we have cash in the account, right? It was cash secured put, so we know we can just buy the stock as required. But if the stock goes below $90, then we're going to lose dollar for dollar, all the way down to $0, right? Which is the lowest the stock price can go. It is not necessarily a bad thing for the short put to get exercised. It's not necessarily a bad thing for us to buy the stock if, for example, it is a stock that we wanted to buy in the first place, right? So instead of just buying, let's say we wanted to buy the stock, instead of just buying it at the current price of 100, what we could do is just sell a put at $80. So if the stock price falls below 80, we would end up buying it at $80. If we like the stock at 100, we may be very happy to buy it at 80. And of course, again, we got some premium in addition to that. right? So investors can sell puts as a way to enter into a stock position at a better price. That's just one use of a short put anyway. And of course, there are many other uses as well. So those were some pretty simple examples. Selling options can actually get a lot more complicated than that. But what we're going to do here is just go over another couple of simple examples to show you why people might want to sell options. Now, all of the examples up until this point were assuming that the options were held until expiration. Remember, I kept saying that prices are as of option expiration date, just to keep things simple. But options do not have to be held until expiration. Most of the time, actually, they are not. Remember, we're talking about publicly traded stock options that can be bought and sold on an exchange. So if we buy an option, we can turn around right away if we want and sell it. Right? We can sell it before it expires. So, for example, let's say we buy an at-the-money $100 call option for $10. In option terminology, that transaction is known as buy to open. So we buy to open a long call. Next, let's say the stock price goes up. So it goes from 100 up to 120, and it happens before expiration. So now the call that we sold, I'm sorry, the call that we bought is now in the money. Because it's in the money, it's going to be worth more. So let's say it's now worth $15. We can choose to sell the option and to close out the position. And if we do that, that's called sell to close. So if we sell to close, we would realize a $5 profit because we bought the option for $10 and we're now selling it for $15. That's a 50% return. Not bad at all. Another example is we can start by selling an option. So instead of starting by buying and then later selling it, we can start off by selling an option, taking a short position. And when we do that, when we start by selling, that's known as sell to open. For example, let's say we sell to open an at-the-money $100 call for $10. So we're selling a call, we're taking a short position. Now, let's say the stock price goes down. It goes from 100 down to $80 prior to expiration. So now, since we have a short position, now that call that we sold is out of the money. And that means the premium should also fall. Let's say it falls to $5. Again, we can choose to close out this position, but this time we're going to buy to close the call. And in doing so, we would realize a $5 profit and a 50% return. On the previous page, I mentioned something about rolling a covered call instead of allowing it to expire. Well, buying to close prior to expiration, that is part of the rolling process. How it works is, let's say we start off by selling a covered call. So we sell to open a covered call. Prior to expiration, we can just buy that call back. So we would buy to close it. And then right after we buy to close, we can go ahead and sell another call, maybe one that's farther out in terms of expiration or strike price. We sell another call to replace it. So we've rolled the call further out. And we could actually keep doing this over and over again, month after month, option after option, just continually roll these calls out instead of actually selling the stock. We just or letting the option expire, we just keep rolling it out, and we would be able to generate an income stream from doing that. Because every time we sell, we generate some premium income. The point is that options are often sold as a result of trading activity that's done prior to expiration, whether that's selling to open, selling to close, whether that's to speculate, to hedge, to generate income, whatever. Most option positions are actually closed out prior to expiration. We're going to look at one last thing about selling options, just to provide some background information about how options markets work, and also to provide another perspective on selling. When we trade options, whether that's buying or selling calls or puts, there's obviously another party, a counterparty that has to be on the other side of our trades. And a lot of people will wonder who that party is and why that party would want to take the opposite position. For example, if we are convinced that a stock is going to go up in price, it's going to go to the moon, and we want to profit from that, we might buy a long call. Now, why would anyone be willing to take the other side of that trade by selling us that call and assuming unlimited loss potential? The answer is, well, for one thing, we could just be wrong, right? I mean, just because we think it's going to go up doesn't mean that that's going to happen. But even if we are right, the other side's reasons, their motivation for doing whatever they're going to do, doesn't really matter, right? Their reasons don't matter to us. Investors use options for all kinds of reasons, maybe to speculate, to hedge, generate income, whatever. Their reasons don't have to have anything to do with our own, right? Now, I know that still does not answer who is on the other side of the trade. And so the answer to that is that investors don't trade directly against each other. So it's not like if I sell a call, I'm going to sell it directly to you or vice versa. Most of the time, investors, we are trading against dealers and market makers, which is the same thing as with the stock market. Dealers and market makers, which I'm just going to call dealers here for short. Dealers are typically large financial institutions like banks and investment firms. And these dealers are typically going to be the counterparties that take the other sides of our trades. These dealers stand ready to buy and sell continuously. Whenever we want to buy, they're going to sell to us. Whenever we want to sell, they're going to buy from us. That's actually a requirement, a condition of becoming a market maker, is the ability and the willingness to continuously buy and sell. That's what keeps markets liquid. It keeps them flowing, moving, and functioning correctly. It's a very important responsibility, but it's more than that. It's also a very big business. Option dealers are ultimately businesses that are selling products. Right? The product happens to be options, but like any product business, dealers are going to acquire inventory and then they're going to resell it for a profit. And because of that sort of business reality of options, the options market, dealers have a very different perspective from investors. As investors, when we trade options, we are looking to profit from favorable price movement, right? Another way to think about that is investors need to take on directional risk. For example, if we buy a call, we want the stock price to move after we buy the call. Of course, we want it to move up so that we can profit, but we need it to move because if it doesn't move, we're not going to make money, right? We're going to lose. Assuming that option is sold or bought when we buy the option, that it's either at the money or out of the money, right? If it doesn't move, we're not going to make money on the trade. Dealers, on the other hand, dealers are in the business of selling a product. They profit from sales transactions, and they typically don't want to take on any directional risk. In other words, they're not trying to profit from how the stock or option prices move. Instead, what they want to do is they want to profit from simply selling the products. The way that dealers do that is through the bid-ask spread. Remember back in part 1, we talked about how as investors, we buy at the ask price and we sell at the bid price. The ask is what we pay and the bid is what we get as investors. Dealers are on the other side of those bid and ask spreads. And in fact, dealers are actually the ones who are determining what the bid and ask are going to be, and they're the ones that are posting those prices for us to see. So from a dealer's perspective, the bid price is the price that the dealer is willing to pay us in order to buy from us, and the ask price is the price that the dealer is asking from us in order to sell to us. The bid is always going to be lower than the ask, because the dealer is always going to buy from us at a lower price than the dealer is going to sell to us, right? The dealer is always going to buy low and sell high. The dealer is always going to buy low at the bid and sell high at the ask. That's how the dealer makes money. The difference between the bid and ask spread, that's called the difference between the bid and ask price, that is called the bid-ask spread. And that spread, it represents the profit to the dealer. This is why dealers are willing to continuously buy and sell, because every round-trip transaction can generate profits. They're just going to continually buy low and sell high. And dealers actually don't care which way the prices move, right? Whether it's up or down, they're just going to move their bid and ask prices respectively. They're going to move their bid and ask and still maintain a spread. Sometimes the spread will widen, sometimes it will narrow, but it's always going to be there because that's how they profit. Now, you might wonder that at some point, price and directional risk, at some point that must matter even to a dealer. So for example, if a dealer sells a lot of puts to investors who want to buy them, and then the stock subsequently falls a lot in price, well, then, that should put the dealer at risk of losing a lot of money. Well, I mean, that's one reason why it takes a lot of capital to be a dealer. But dealers are also very aware of this risk, right? They know what risk they're taking on, and most of the time they're going to actively hedge away their directional risk. So for example, let's say a dealer sells a put. So now it is at risk of losing money if the stock price goes down. Now that dealer can take an offsetting position by shorting stock to hedge away the directional risk. In other words, if the stock price falls, the dealer may lose money on the put, but it will also make money on the short stock position. The net result is zero directional risk. The position stays flat. This is known as delta hedging or a delta neutral position. Now, it's more complicated than that, but the point is that, when dealers eliminate their directional risk, they can just focus on making money off of transactions. They can just buy low, sell high over and over again. It doesn't matter which way the prices go. The more that we trade as investors, the more money the dealers make. So this is just another way to think about and to understand option trading. It's not what we see in the movies where there's a bunch of adrenaline junkies on a trading desk speculating on price action. Big dealers don't want to gamble on stock price. That's not what they're here to do. They would rather eliminate price uncertainty both ways and just focus on extracting profits from every single transaction. It's a very careful, calculated, and serious business. All right, so here's a summary of part 3. Short calls and puts have limited upside, which are equal to the amount of premium received. If we sell an option for $10, the most we can make is $10. On the other hand, for a short naked call, there is an unlimited loss potential, while short puts have a maximum loss which is equal to the break-even price, which is calculated as the strike price minus the premium received. Now, even though the P&L profiles for short options may not look that good, there are actually many different ways we can use them. Investors often combine short options with other positions, positions like a long stock position, for example, to improve outcomes. For example, we talked about how we can sell a call while holding the underlying stock to create a covered call position to enhance a sale at a desired price. Options don't have to be held to expiration, and in fact, most options are closed out before expiration. That can be to trade options for short-term profit, to roll contracts to generate income, or whatever. Finally, dealers are the institutions that take the other side of trades, and they're the ones who keep option markets working correctly. Dealers are not in the business of trying to bet on stock price movements. Instead, they want to eliminate directional risk so that they can profit on transactions regardless of which way prices go. That wraps up the series. In part 1, we talked about the basics of options. Part 2, we looked at long calls and puts. And of course, here we talked about selling options. It was a lot of information, but honestly, it's also only the surface. There's just so much more to options, and we could spend forever trying to learn all about them. But hopefully this introductory series helps some people get started on that journey. I may expand on this series in the future, but for now, I'm just going to leave things here. So thanks for watching. I hope you enjoyed the video. If you did and you'd like to see more content, please like, subscribe, share. If you have any questions or comments, feel free to leave them below and I'll do my best to respond. Thanks again.